Thinking of investing in stocks but don't know how to start? If you're a total noob when it comes to stocks and investments, then you're in the right place. Here's everything you need to know about stocks. The history. Stock markets are what can be called the bedrock of the modern economy. Their inception marked the beginning of what is now utterly commonplace: multinational corporations. It all started long ago when trading companies of Europe undertook long journeys to all parts of the world to bring back goods and precious items. They completely changed commerce and revolutionized the access and availability of materials both in their home countries and abroad. But they couldn't function without a solid financial backing, which is why they weren't the responsibility of a single or group of individuals, but entire mass of people, or the public, who purchased shares of stocks in those trading missions and then took both the risk as well as the benefits of a successful trade mission. You couldn't just buy into these stocks, but also sell them to others, and thus the profession of trading stocks to make a living was born, at least in its modern form, where people make a living by holding on to stocks that they think are valuable, by investing their money into it, and then reaping the rewards when their faith in that company pays off. In today's age, our global economy wouldn't function without stock markets, since many of the major functions within our economy are fulfilled by publicly traded companies, listed on stock exchanges, available for people to buy in or sell their stocks. Which is why, as a modern ambitious citizen of the world today, you should have an understanding and possibly play a part in this trade, reaping the rewards and participating in keeping the world economy going. Here we are going to list some of the things you need to know before you get started with stocks. Or, even if you're already trading stocks, these ideas will certainly serve you well in the long term and short term of your trading journey. So, let's get started. The first idea might sound simple, but it's very critical, and you'd be surprised how many people get it wrong. You have to buy low and sell high. Sounds simple on the surface, but you gotta fight your basic intuition where something being cheap needs to be seen as a bad thing. Nobody laments cheaper groceries or gas prices. But in the stock market, even a moderate fall in the market can be seen as a life or death situation in this trade. Another thing that is imperative to always keep in mind is that in stock trading, there's no sure shot situations. To prove this, one just has to look at some things that were taken as gospel formerly, but we've seen it break down, such as oil prices being said to stick to $100 for the long term, or Alibaba, the Chinese conglomerate, is an unstoppable force that you can't go wrong with, or that ESPN cannot be affected by the dynamism in the cable business, and that its ability to make money for Disney will be a sure shot thing. Just three facts that used to be taken as set in stone that have turned out to be full of flaws. However, that doesn't mean that conventional wisdom is always wrong. However, it may not always stand the test of time. In fact, some of the most prestigious investors, such as Warren Buffett or Carl Icahn, have history of placing some of their biggest investments into companies out of favor or in times of market stress. Furthermore, while aiming for long-term gains with investing in stocks has historically been shown to be fruitful, singular companies have been obviously riskier to invest in. Filings. Another incredibly important point is that no matter how good an investor might consider their instinct for spitting good companies to invest in, there is no shortcut around filings, and we have to do our homework with them. To start with filings, there's no better place than regular filings that companies make with the SEC, which contain every kind of detail you need, from company finances to potential risks and conflicts. The 10K, an annual report, contains the most comprehensive data, everything from quarterly to annual records to business lines details, as well as commentary of the management on opportunities' cost of growth. They will also detail any changes within senior management, as well as major acquisitions, stock transactions by important people in the company, such as executives or board members. The SEC's EDGAR system will provide filings for all American public companies, as well as foreign ones that list themselves on American exchanges. Think long-term. You must also make sure to think long-term. It's not just taxes that make short-term trading a losing game, but trying to buy or sell shares only on the basis of quarterly numbers or just specific data points is something suited for automated trading platforms, not for the everyday investor. More worthwhile opportunities only come when a certain stock or sector which has been dismissed by most of the market and is languishing despite showing steady economic returns that are going to be able to produce a long-term profit stream. For example, transportation stocks, such as airlines or railroads, have passed through long stretches of inattention by the market, but only to eventually deliver sizable gains when economic conditions align with industry dynamics. For instance, many years of mismanagement within the airline industry led to many bankruptcies in the 2000s. However, the resultant merger wave made United Continental, American Airlines, and Delta more competitive and made them ready to benefit from trends such as declining fuel costs. Befriend dividends. The next idea to keep in mind is that dividends are your friend. For instance, Apple's share price in 2015 dropped 11% from $110.38 to $105.26. However, those who owned the stock lost not 11%, but just 3%. And you'd want to ask how that's possible. That's because of dividends, since Apple paid $2.03 in dividends throughout the year. However, stocks that pay dividends aren't safe from decliners either, but they still offer some protection that other stocks that don't carry dividends don't offer. However, a word of caution would be that dividends that are so high that they're too good to be long-lasting often don't end up lasting long. For instance, the owners of Kinder Morgan learnt this the hard way when their quarterly payout dropped by 75% recently. But, in summary, dividends are a good thing, and statistics have shown that bulk of the S&P 500 returns over the years have been seen to come from dividends, not price increments. There's no perfect metric. Furthermore, one thing worth noting is that there is no such thing as a perfect metric, period. Both amateurs and professionals have their favorite metrics of measuring growth and value, from price-earning ratios to dividends and profit margins. However, no single metric exists that can nearly divide good stocks from bad stocks. For instance, a stock that may look cheap at 10 times earnings can very quickly go to 5 times, and a shiny tech company might look expensive at 3 times sales can reach 6 in no time. An important price, too, about stock prices is that a stock that costs $100 isn't expensive, and a $5 stock isn't necessarily cheap. The price of a single share should not be the number you use to judge if a stock is a good buy or not. While stocks that have a 3-digit price may be too much for a new investor with finite funds, but it's also not wiser to stock up on $101 shares either. You have to compare investing like you think of grocery shopping. You don't just buy things based on price tags, but rather you buy what's on your list of needs. Taxes. One thing that many people don't take into account is that taxes can end up taking a big chunk of your profits. For instance, the stocks of the FANG group of tech companies, namely Facebook, Amazon, Netflix, and Google, had a great year in 2015, giving returns that range from 34% up to 134%. However, from the tax point of view, every investor that bought the previous year and was eyeing the exits now wants to keep them climbing. This is because for the taxman, the 1-year mark is the demarcation line. This is because if you sell stocks that you've had in possession for less than a year, it makes it a short-term capital gain, which is taxed as ordinary income. So this could end up meaning that anywhere from 25% to 39.6% could land in Uncle Sam's pockets. However, if you manage to hold those same stocks for at least 12 months, you'll end up paying only 15% for most tax brackets. One of our final pieces of advice is to always know what you actually need and what you're going to pay for. The ever-evolving stock brokerage firms are always in ever-increasing competition to offer people the biggest and newest trading options. But for the most part, investors can find their basic essentials anywhere pretty much. So you should be aware of the kind of buy or sell order that you're entering into. Such as a market order will be taken to execution as soon as possible, no matter the prevailing market price. Meanwhile, a limit order, in contrast, can only make a complete transaction if the price parameters that you've set are met. Be careful of taking the news too seriously. And last but not least, you must take the market news with not a grain, but a whole bag of salt. For since the first day of 2016 had no shortage of breaking news, everything from a sinking Chinese stock market to General Motors investing in Lyft, the Uber rival, and the tensions in Saudi-Iranian relations. But is all of that news a reason for American stocks to plunge any more than 2.5% as they did before bouncing off their lows? So, as an investor, you should take such news, which is a driver of day-to-day shifts and changes in the market. And as an investor, the news flow driving day-to-day gyrations in the market should be taken as interesting reading rather than a reason to make or change strategy. And with that, it wraps up the video. Thank you for watching.